What's going on, family and friends? This is Todd. I'm not financial expert nor licensed professional. If you want to try and invest your money in the market, consider want to avoid the risk. Invest with trusted investor advisor. Today's video we are going to talk about selling put option, how to generate steady money weekly or monthly. Before I get to do that, all I ask to hit subscribe button. It really helps the channel to grow. Let's go to the video. Selling buying stock can be complicated enough. Selling option is a strategy that investor banker that generally use. In my first video, I did the talk about selling covering call. Actually, selling cover call can be one in the most saving way to invest. You can come back to my first video. You will see the detail and the explanation. But the difference between selling cover call and selling put option. Selling put option is different. Unlike to sell covering call. You don't have to own the commodity for the stock. Sometimes it's very risky. I think is no difference to owning the stock itself. Selling covering call, you need to own 100 shares before you do the strategy. In order to be successfully on any strategy, you have to understand the risk. I will go over in this video. First, let's go talk about option. Option is contract between buyer and seller that specify for four things. First, a right and obligation between the buyer and seller. The second, the underlying security. The third, the expiration day. The fourth, the strict price that you go choose. With the put option, the put seller sell the option to buyer. The put buyer get the rights but not an obligation to sell an equity or commodity to the option seller. The third, within specific time period. The fourth, set price, strict price, called strict price. In other words, the put seller may require to buy something from the put buyer should the buyer decide, and the put buyer specific what this something is the underlying security, as long with the strict price and expiration day. The buyer have the option to exercise his or her rights at any point until the contract expires. Let's see example in Robinhood. For example, let's go to the take a sample. SPY is ATF. And SPY is 442. And we go on trade SPY. And as we go choose expiration day. The expiration day for SPY is 3 times in the week. Expiration on Monday and Wednesday and Friday. August 9, Monday, Wednesday, Friday. 3 times in the week. That means we can generate steady income 3 times in the week. If the stock SPY, of course, go in the direction we want to go. Let's go choose Wednesday, August 11. Let's go say that we want put sell, and we want to choose the strike price at 400 442 442. And we click in here, and as we see in here, 400 expect profit and loss 142. In this case, the option buyer has the right to sell SPY at any point before the option contract expire, which here in August 11 at specific price. The strike price is 242, like we say. And as exchange, the put seller, that's me, I want to sell puts. I can collect an option premium, which $1.42 time Henry is $142, and guarantee income that the put seller, that's me, to keep every 3 times, like we say in here in SPY: Monday expiration day, Wednesday expiration day, and Friday. The put seller, that's me, can report option weekly or monthly. In this case, it's 3 times in the week. No matter what happened. For example, if SPY an expiration day is 42.37, the contract go worthless, expire worthless, and I still keep money handy, $42. But let me tell you about this strategy. This strategy, you need to have collateral money, and collateral money, that means money down that you need to have in your brokerage, is the strike price 442 time 100 is 44,200. You need to have this money. If we want to continue in here and review, you don't have enough buy power to buy this order. That means I need to have 44,200 collateral, the strike price time 100. The 442 time 100 is 44,200. Just explain for you how this work. Any investment need to know about this basic thing. It's important to understand the mechanism, rights, and the obligation, and the overall risk. Typically, retail like me and you invest, buy, and sell put option. And this example is the ATF SPY, which most people sell puts, and SPY is the most famous S&P 500 index that a lot of people generate 3 times income in the week. And you can collect income the premium for selling this put option 3 times in the week. But remember, when you sell and put option, you giving the buyer the rights, but not the obligation to sell you the underlying commodity or security. In other words, you may need to be able to buy the underlying commodity or stock or ATF. You need enough collateral, like we see in this example, 44,200. This collateral will be in form cash or margin in your account. Remember, you the put option seller agree to buy something specific in future in the buyer request. Your brokerage account need to have a money the 44,200 whatever strict price you should to for to afford the purchase. However, many stock and ATF now offer wide range in expiration day, like we see in here in SPY. In other words, you can sell weekly option and collect income much every week. In general, you can earn between 1 to 5% or more month selling weekly or monthly put option. All depend on your trading strategy. How much you earn depends how volatility the current stock is, the strike price, and the expiration dates. In other words, the more risk you're willing to take, the more income you collect. Similarly, the more unstable the markets are, the greater the income can give me the most income. I prefer selling put options slightly out of the money with expiration day 3 or 6 weeks out. Out the money put option. What is out the money put option? That means the strike price is the lower than the underlying security. For example, the strike price for the underlying security is the strike price is the share price 442.37 and you selling for 442. This is the out the money. First, you must remember by selling weekly or monthly put option, you agree to buy the underlying equity. Should the put buying with which at any point until expiration day. The risk in selling puts, you may end up being forced to buy something much less than what's worth. For example, if we sell puts at 442 an expiration day, the price hits, for example, 440. I am obligated to buy it at 442 strict price, but the price for SPY is $440. That means I'm losing the money because the price between 442 and $440, that's how much I lose. To manage the risk, To manage the risk, you need to be sure wherever you sell put option and thus is a quality stock ETF, you'll be happy to own at with agreed strike price. And once you own it, you can do whatever you want. For example, this SPY, I sell put at 442. If an expiration day SPY hits 442, I will be forced to buy the Henry share for SPY for 442. That means I need to make sure that's what I want to own in future. Let's go real. Selling puts option guarantee, like we say weekly or monthly. In this case for SPY or ATF, is 3 times in the week. It can be profitable month after month after month. For this case for SPY is week after week and after week. The key is to remember to sell put option on only high quality equity that you will actually want to own. I mean, you already want to own the stock, because you may be forced to buy them. Like I say in this case, you might be wondering if you can lose money selling put option. This is the question. You may be wondering, if I lose money. Well, you never lose the income from selling put option. The income you receive from selling put is guaranteed. However, if you force to buy the underlying and equity and you sell the underlying equity on loss, then you may lose money. Like mentioned in this example, you sell put for 442. In expiration day, somehow SPY is 420. Yes, you will lose money because you will be forced to buy the stock at $442, not at 420. Loss, want something you can reduce your potential risk or make even more money selling put option. When you sell a put option, if the equity has gone up considerably, your option will be likely be profitable. So you could always close out your trade. For example, if the SPY, which my strike price is 442 and expiration day is $450, is profitable. Before expiration day, you see that the SPY is up. You should close always your trade and gain your profit. Buying back the identical option, and you can do it again at lower price. Why you want to do that? Well, you can sell put option and report the process if you have again and again for generate the income, and you can repeat the process. You close the trade, you take your profit, then you go again sell the option at lower price, and you can repeat the process again and again like SPY 3 times, and you can collect the income. If you have any question, leave it in comment below. I will see you in next video.